Yeah.
Yeah. Well, I think Todd Horn is on. Todd is our new board chair, and we're going to do something a little bit different this year. So it will not always be Todd leading the session, but we did ask him to lead the first one. And so, Todd, I will. We're at time, so I'm going to turn it over to you as we're adding more people in, and we'll go from there.
All right. Well, thank you, Dean. Good afternoon and Happy New Year. Just super excited about the next 2 years and serving as chair of this awesome organization. Like Dean mentioned, I'm Todd Horn. I'm president of Clayton Construction Company. I'm based in Spartanburg, but travel all over this upstate and have been involved in this organization for many years. And couldn't be more thrilled about the direction that TATT at the Top is headed. And a lot of that has to do with the people on this call and our funding partners, which we're very grateful for. So another successful year last year in 2023 for TATT at the Top, 78 total regional engagements with over 2,614 total participants. So our footprint continues to we continue to see a lot of folks getting engaged that don't know about TATT at the Top. We're very proud of the story that we're telling across this region and excited to see those numbers continue to go up. You can also see on this slide our leadership level funding partners, which support at the $10,000 and above mark. We're very grateful for these organizations that help us from a funding partner standpoint. We also have approximately 80 individuals and organizations that provided support of TATT at the Top in 2023. So if you're on this call and you're a funding partner, we are very grateful for your support. We couldn't do the work without you. We're continuing to see folks, again, find out about TATT at the Top and want to support our efforts. So if there are companies and organizations that you're aware of that we need to be talking to, please let us know. We are more than happy to go share the story and what's happening within the organization. Hopefully some of you were at the Celebrating Successes event back in November, one of our signature events that we hold. We made a end of the year goal that day to raise an additional $20,000. For those who attended may remember, I got up in the end and kind of challenged the room and the region to help us with that end of the year funding. And I'm happy to support or happy to share that we ended up with $22,350 from that campaign. So that was a huge win for us at the end of the year. If you were a part of that, we're very grateful for your support in that space as well. Each year, we also hold our kickoff reception for board members, funding partners, and community partners. We are holding that this year on Tuesday, January 30th at the new Southern First Bank building off of Verde. If you have not been to their space, it is a wonderful place to gather and a really going to be a great place for us to have some networking and enjoy. I think, yes, thank you, Erica, put that in the chat there for registration. So please check that link out if you have not registered yet. And with that, it's my pleasure to introduce our speaker today for the first TATT at the Top chat for 2024. It's good to have Dr. Scott Bair back from Clemson. I don't know if he's talked with his head coach yet. I know there's a lot of buzz right now in Alabama with Nick Saban leaving, and if their coach is going to leave, and I know that's been talked about for years, but I'm sure there's chat on campus happening. But good to have Scott back with us to give us an economic preview for 2024. Scott has been sharing his economic insight with us since we started these TATT at the Top chats back in 2020. Scott has an undergraduate and master's degree in journalism and economics, respectively, from Bowling Green University, and a PhD in economics from Michigan State University. He served as a faculty member in the Department of Finance and Business Economics at the University of Notre Dame before joining the faculty at Clemson in 2001. He is currently a professor in the John E. Walker Department of Economics and also serves as the department chair. So join me in welcoming our friend Scott Bair. Thank you, Scott.
Well, it's good to be back again. And how long do I believe I have 30 minutes? Is that correct?
Yeah, I think 30 minutes is good. We do want to leave some time for Q&A. So I think, Dean, is that right, 30 minutes?
Mm-hmm.
Okay.
All right, so I'm going to get rolling here to make sure I can get through most of these slides. So again, so we're off to I think the start of 2024. And if you remember going back last year, and I was chatting with some of the people before we came on live, that a lot of the talk last year was when were we going to go into a recession in 2023. But as the year went on, the economic output improved throughout the year, and I think where we start at the beginning of this year, I think things look pretty good for where we're going to head. I don't foresee an economic recession occurring in the first or second quarter of this year. And again, and as I'll talk a little bit about as we go on, we even heard some talk about the Fed easing on interest rates last time. So again, some notion that the Fed is now not solved the inflation problem, but got inflation down back close to within its target range. And maybe by sometime in the first quarter, second quarter, we'll start to see the Fed ease off of interest rates a little bit. So let me go ahead and kind of get started through. So I'm going to start out with a summary. And so kind of as I just mentioned, in the December meeting, the Federal Reserve decided to hold the federal funds rate at between 5.25% and 5.5%. But again, I think the main news that came out of that December 12th meeting was that it was about time that they were going to begin to think about lowering those interest rates. Up until then, the November meeting, October meeting, and back to August and July, the Fed was taking a very hard stance on where interest rates were going to be and how long interest rates were going to have to be elevated because they were concerned with how high inflation was. So again, I think that's one of the better signs I think we've received recently. That again, the Fed believes that inflation is almost within the range of where they would like it to be. In some sense, it can almost claim mission accomplished. That inflation has gone down without us going into having much of a recession in terms of lost output or GDP. Also, the good news that came in was the third quarter GDP came in a lot higher than I think most people anticipate. It's been revised down a little bit, but it was roughly at 5%. And that was a really high growth rate for something, again, what we've seen relative to the last few quarters. And we'll talk some more about that and what were the underlying drivers of that. And again, as I mentioned a couple times already, inflation continues to trend down, which I think that's good for consumers, and especially in some components of inflation. If you go past a gas station now, you can see gas prices are quite a bit lower. And so again, that's allowing our spending dollars to go a little bit further. So again, inflation coming down and some relative prices are even actually lower than what they were a year ago. And then the labor market continues to add jobs. It's slowing down quite a bit. And this is the one thing I think that we should watch over the next few months of what happens in terms of the number of jobs that are added each month. So all in all, I think we're in a pretty good position, continue to add jobs, inflation trending downwards, and positive GDP growth. But the one thing that doesn't seem to line up is that the economic news or the reporting that we see doesn't align well with this data or the data that I'm talking about. So if you go back and kind of look up until the pandemic, again, just using some different techniques, we've been able to map pretty well consumer sentiment into what the data tells us consumer sentiment would be, and they kind of track each other pretty well. If we add on what's happened after the pandemic, there is a big gap between what the data is telling us and what consumer sentiment is, and it's been a real puzzle. That the data keeps coming in, above expected or in the direction that we would hope. But when we do these reports or when you talk to the person on the street, they're end up being quite pessimistic about where the economy is heading. And maybe that's because the news we listen to Now we all have our own echo chambers, whether it's MSNBC or Fox News. I think you're bombarded constantly by how the other party is screwing up the economy and how they're trying to run us off the cliff. But again, if you look at the data, and these are the main indicators of what the NBER uses to say whether we're going into or heading into a recession, they're all trending up. So we look at things like non-farm payroll, what's going on with consumption, GDP, industrial production. All of those things have trended up from where they were in 2021. But when you ask individuals about what they feel about the direction of the economy, it ends up being quite negative. So again, I'm going to rely on the data here to tell a more positive story where I think the economy is. And I'm also going to use some more recent data on people's expectations about where they see the economy going on different components, not the overall state of the economy. Again, I think that'll paint a little bit more rosier picture of the direction. But again, there's always some caveats that are going to be in here, and there's some things that we should be looking for, or we're going to see some slowdowns. And of course, it is election season. So when you throw politics in, and politics and economics don't always mix well, they tell nice stories. But again, when they clash, sometimes we get worse outcomes than we would otherwise. So if we look at the long history of, now this isn't a terribly long history, but if we look at going back to 1947 up to 2023, again, one of the main things that we look at when we talk about the state of the economy is GDP. And basically, again, how we should think of GDP is that GDP is just simply a measure of income, and it's a measure of production. So it's capturing actually two things. It tells us how much we're making, what our income is, and what is the value of our overall production. Now, one thing I think, again, I like this slide, and I keep it in here, because I think it tells us something important. If you go back from 1947 up until about the year 2000, GDP grew at about 3% a year, and you would have some periods where GDP grew a little bit faster, expansions, and some periods where GDP was a little bit slower. Those, again, of course, are recessions. The one thing that it becomes notable here is if you would continue that trend out past 2000, beginning again, really around 2000, but not necessarily caused by the Great Recession, you saw a slowdown of economic growth. And this is a pretty big gap here. If we could have some magic policy to move us from where we are currently up to where we should be today, that would end up being about I think, what was the number I calculated this morning? It would be about $16,000 per person they would have more this year than they actually have. And so if you did that gap for every year, we would be a lot more we would be wealthier and have a lot higher income. So one concern, and what economists still try to answer, is what's accounted for this slower growth since the beginning of 2000. So again, prior to the year 2000, real GDP growth averaged about 3%. And if you look at what's happened since 2000, here's the same data. This is real GDP and growth rates, rather showing it in a column chart rather than a line chart. And you can see if I drew in that 3% growth rate, what you could see in most periods, you can see that we've underperformed the long run average. So only about 36% of the time has GDP growth exceeded that 3%. And one thing I've done in several of these charts here, and I'll say it briefly, is I've eliminated this little period here of the pandemic, because the changes were so big during the pandemic. If I include those, they distort the whole graph, so that we could see what's going on pretty well easier. There'll be some charts where I just get rid of what happened during the pandemic without really loss of generality. And you can even see over the last, say, 6 quarters going into this last one where we finally went up above 3%, again, we've been underperforming what we normally do. So again, why the underperformance? There's several reasons. One is we have slower population growth, and the demographics now are beginning to move away from what would lead to higher population growth. We've also had slower growth in educational attainment, and that goes without kind of much surprise, going back to the 1910s, 1920s, when we were educating lots of people, first getting high school degrees and college degrees. It was going to have a big boost to the economy. Most of those gains are already occurred, so we're not going to get much from educational attainment. Productivity growth has slowed quite a bit. Some will blame inequality as a reason why we've had slower economic growth, and another reason why we've had slower economic growth for the last 20 years could be due to taxes and regulations. And depending on what side of the aisle that you stand on, you may take a different view of the tax structure and the structure of regulation that has slowed growth. But the one thing I think underlying a lot of this is a big concern of economists is, why haven't we been growing like we did from 1950 to 2000? So, but most of this talk is going to be about recessions and where we're going to be heading over the next year. So again, when we think of a typical recession, what causes a recession? Well, typically they occur when there are imbalances in the economy. And those imbalances end up resulting in in periods of slack in output. So these imbalances are caused by shifts in demand that for some reason are large and end up being and sustainable over long periods of time. And what occurs then is supply can't adjust rapidly enough to reallocate resources from one sector to another. And then again, it takes some time just to unwind those problems. So again, that length of the cycle of the recession can depend on the performances of the demand shock and the appropriateness of the policy response. Sometimes the imbalances are easy to identify, and other times they're more difficult to come up with. And also sometimes these imbalances may result in inflation, and inflation may be the result of an increase in demand or decreases in supply. So what I'm going to do is I'm going to talk a little bit now, one more slide. I'm going to kind of get into the heart of things. I'm going to walk through what's going on in the economy on the demand side to see if there's anything in here that would be indicative of imbalances that may think that there's something that's going to get out of whack in the next year, or something that looks out of whack now that will cause a recession, or something that looks misaligned that will cause additional inflation. And again, as of right now, I don't think there's much underlying here that would lead us to believe that we're heading toward that. So again, going back to a shorter picture of GDP over time, or income over time, the last 20 years have been characterized by really two different types of recessions. You had the Great Recession, which had an L-shaped recovery, and by that we mean GDP went down and it never bounced back up to that old growth rate before. And that was an imbalance in some sense that was man-made. That was an imbalance, you could call it the housing bubble or due to structural finance. That was in some sense a man-made phenomenon that caused the economy to go into a recession. It took time to reallocate resources and for growth to start back up. The pandemic, however, was more of a V-shaped recovery. And again, that was a recovery, that was a recession where you saw a dramatic decline in GDP, but also a rapid bounce back. And I think the difference in these two things were that, again, the pandemic was something that hit a relatively healthy economy, and it lasted a very short period of time, so the economy was able to bounce back quickly. There weren't any other structural problems underneath it. So again, not to downplay the loss of life that occurred during the pandemic, but you could also almost think of the pandemic from an economic standpoint being like a bad snowstorm that kind of shut a city down for a period of time. But once that snow melts or the plows come through, things go back to normal. And that's kind of what the pandemic was from an economic standpoint. We were just able to go back, in some sense, most people back to how things were before. So again, when we talk about the demand side, it's going to be, when we talk about the recessions, it's going to be easy to talk about the demand side and where the imbalances come from. So again, as I've done before, we're going to break things up and think about GDP from its components: consumption, investment, the purchase of plants, machines, and equipment, government spending, and exports and imports. And so again, remember, the biggest component of GDP on the demand side are you and I as consumers. We take consumption is about 2/3 of GDP. Government investment are about 20%, and then exports and imports are a little bit negative. And so the way we're going to think about what's driving GDP now on the demand side is to do an accounting technique. Is we're going to look at GDP growth, and it's going to be a combination of consumption, investment, government spending, and net exports. And we're going to think about how these things, consumption, investment, net exports, and government spending, drive GDP. So the way we're going to think about it, again, is something simple like, if consumption accounts for 2/3 of the economy and consumption grew, our spending grows by 3%, then we take that 2/3 times that 3%, and we say consumption had contributed 2 percentage points to economic growth. And so, or GDP growth. And so that's how we're going to do that. And we'll walk through, then go take a deeper dive of what's going on underneath of all of these components. So let me skip these slides here because they don't matter as much. So just to make sure we're staying on time, which we're not, but I'll hurry through. So if you look at if we look at consumption's contribution to GDP growth, we can again notice that this last quarter, it contributed about 2.11 percentage points of that 4.9% to GDP growth. So again, consumption was a non-trivial driver of GDP growth. And if you look kind of back through time here, the one thing that you'll notice is consumption is almost always positive. Consumption growth is almost always positive. I should say consumption growth was a little bit negative here during the Great Recession, but generally speaking, consumption is a positive driver that pushes GDP growth forward. So through 2019, consumption growth contributed about 1.56% to GDP growth. So about 70% of GDP growth on average was driven by consumers. If you look about what was happening coming out of the pandemic, from the end of the pandemic until where we're at now, on average, consumption growth has accounted for over 2.5 percentage points to GDP each quarter. And that's about 82.5%. So you'll hear economists talk about, well, consumption's the real driver coming out of the pandemic. And those are the numbers that underlie it. About 82% of the growth in GDP that we've seen has come from the consumption side or from the consumers. And again, why did that? As I've talked about before, one of the things that helped consumers along coming out of the pandemic was that the real disposable income didn't fall by much. And why was that? Well, we had that massive government stimulus, and that allowed consumers to have additional money above. And again, this is what was shocking about, in some sense, to an economist or even in most people, was that during a recession, we typically think that people's income goes down. But with all that additional stimulus the government put into the economy, real disposable income for households actually went up. Here's one thing that we should be concerned about a little bit now, is if we draw in this artificial trend line here, real disposable income right now is below trend. So again, we worry about, again, that slower growth in disposable income. If that slows down, so eventually that means consumer spending has to slow down. So again, keep an eye on what's happening with this real disposable income over time and see how that's going to impact consumption. As you can imagine and would see, consumption tracks pretty well with disposable income. As that disposable income went up, we come out of the pandemic, that additional income allowed individuals to consume more. And again, drawing in these nice trend lines here, trend lines here, we could see that consumption's basically back up on trend. The one thing though that remains a puzzle, I think to me, and I think to most economists, is that one of the things that happened coming out of that we knew it was going to happen during the pandemic was that when the economy kind of shut down and we couldn't go anyplace, our consumption turned away from services because we couldn't go to movies, we couldn't go to the theater, we couldn't go out to restaurants, and it turned toward it turned toward good consumption, in particular durable goods consumption. I bought a new TV so we could watch movies at home. I bought a new computer so I could work from home. We added on to parts of our house to make our home a little bit better. We thought that was going to be more or less a temporary phenomenon, but if you look at durable goods consumption, and to a lesser extent durable consumption, it has remained elevated, even though we would argue that we're pretty well out of the pandemic. So one thing that really changed, and it hasn't renormalized yet, was households and consumers kind of tilted their consumption away from services and are consuming more durable goods than they would otherwise. It's up about 14 to 15% of where I would expect it to be if it was growing along that trend line. Another thing that's helping drive consumers is that when the government injected all of that stimulus into the economy, the consumers didn't spend all of it. They saved a fair amount of it. And they're roughly sitting over the most recent calculation going back to about October 5th. Consumers are still sitting on over $1.1 trillion of excess savings. So even though disposable income is lower than what that trend line would indicate, consumers are sitting on a pretty big nest egg that they saved up. And you could see what's depicted here. They're kind of going through that excess savings now. So again, another thing to watch or keep an eye on is what happens to that savings of households and how quickly do they go through that. But again, as we look at it now, again, they've been burning down that savings, but not at a really rapid rate. The other thing that I think we should be concerned about on the consumer side, or something to watch, at what's happening on the borrowing side. Two areas in which we've had a increase in borrowing is in terms of auto loans and student loans, even though that kind of student loan is kind of plateauing off. One thing is, again, another thing to keep an eye on is now that those students who had loans before have to pay those student loans back. How is that impacting their consumption? What's happening to the overall size of student loans? And again, how are the increase in auto loans, is that going to put a crimp on people's consumption down the road? And again, another thing to worry a little bit on the debt side here is you see that uptick of credit card debt. So again, additional debt, again, would give us some reason to be concerned. On the investment side, there's a lot going on investment, and I think a lot of it cancels itself out. But generally speaking, I am, again, taking a very neutral stance on what's going to happen with investment. And again, when we say investment, what we mean typically by investment as economists is not financial investment, but the purchase of plants, machines, and equipment. And how it's categorized when we talk about GDP, there's really broken into three categories: the purchase of fixed investment, which are plants, machines, and equipment. And then changes in business inventories, which is a real oddball. And again, it's made even more volatile because of the pandemic. And then the last one is residential investment, the purchase of new homes. So the drivers of each of these components are different. And I'm going to talk about what I think is going to be going on in the year ahead, and then going forward of what I think is going to be happening with investment. And so here are each of those components. And this is the new chart I added. I think it was more fun to make than to look at, but it depicts all of these different aspects. Fixed investment is the blue part. And the one thing I think you could see by the fixed investment is that has a tendency, that's really always positive. It varies a little bit, not as much as the other ones. Residential investment has a little bit more volatility. It's the orangish ones. Here you see it's negative, here it's negative, and a little bit positive. It kind of moves around. But the big driver of investment, and the one that's really hard to, it switches from one way to the other, is that changes in business inventory. So that's either I'm bringing in raw goods and they're in my factory warehouse, they haven't been processed, or they're goods that are finished in my factory that haven't been shipped off to the next location. So those are the two things that lead to inventories. And again, this has always been one of the more volatile aspects of business investment and GDP. It's been made worse by the supply chain disruptions that occurred because of the pandemic. If you look at fixed investment, the last quarter, it was positive. If I'm going to forecast forward, what do I think is going to happen to fixed investment? Again, I'm going to take a pretty neutral stance on that. And I spent some time thinking about what was going to happen to fixed investment over the next year. And then I turned to a couple indices that I haven't looked at until recently. What's the main driver of fixed investment? If I am a business manager, I'm thinking about adding plants, machines, and equipment, and that's going to be based on what my forecast of the economy is going to be over the next couple years. And the Atlanta Fed has started to put together a series in which they survey business owners and firms and ask them about their sales growth, expected employment growth, and other things. And I've just depicted expected sales growth and employment growth. And if you look at this chart here, what are the takeaways from this chart is, one, if you look at what expected sales growth is, on average before the pandemic, firms are expecting 4.5% sales growth. You can see that sales growth now is, for a while, it was above that 4.5% as we were coming out of the pandemic and consumers were buying goods, a lot of goods. Now, businesses, managers are forecasting a little bit below that 4.5%. And if you look at employment growth, again, we could see is the business managers are expecting a little bit lower than average employment growth. So again, both of those things, if I want to read these things, I think both of these things indicate that their expected sales growth and employment growth are going to be a little bit below average where they were pre-pandemic. So my forecast of fixed investment would be roughly what it was like before the pandemic, maybe a little bit lower, but again, nothing that I would expect that would lead to a real pullback in terms of the purchase of plants, machines, and equipment. Just as important, I think, is what businesses think about uncertainty. And that Fed survey also captures a measure of what business managers think about the uncertainty of sales and the uncertainty of employment growth. And so the takeaway I get from this graph is employment growth uncertainty has returned to pre-pandemic levels. I think that unlike what we had the last 2 years where firms were really worried about if they're going to be able to get the employees they want, there's been a little bit of a return to normalcy. The other area that remains uncertain, it remains a little bit elevated, is there seems to be additional uncertainty in terms of what's going to happen with respect to sales. And again, I typically think that when there's more uncertainty about the economic environment, you'll probably see firms being less willing to invest in plants, machines, and equipment. So again, that makes me think a little bit that fixed investment will be a little bit lower, but not that much lower than what it is normally. Again, here's inventory investment, and you could see this really seems to have no real persistence. One quarter seems to be different than the next quarter. And again, I think the big thing that the economists and firms are still trying to grapple with is what the new world is going to look like post-pandemic as we move away from just-in-time management to more just-in-case management with our inventory. So as I've talked with people who work at the Treasury, and I've talked with people who work, with trade organizations and firms in general, is how they manage their inventories and how their suppliers, how they manage different suppliers hasn't returned to a sense of where they feel comfortable with yet. And there's still some real concern on the government end of securing up those supply chains and supply chain management and making sure that some of those kinks get worried out. So again, from the business investment side, there's a way to go before we return to normalcy. And of course, residential investment, surprisingly, last quarter residential investment contributed positively to GDP growth after 9 consecutive quarters of negative contributions to GDP growth. And again, why was residential investment negative for such a long period of time? Well, it goes simply to interest rates. If you look at mortgage rates, the fall in residential investment coincides with that run up in mortgage rates. And if you've been watching mortgage rates like I have, because we've been looking to move a little bit closer to Clemson, the one noticeable thing that we've seen in the last couple months here is that the mortgage rates have fallen quite a bit, over a whole 100 basis points in the last month or so. And so a couple things I think I noticed here with respect to the region is as those mortgage rates went up, you still saw they really didn't slow down the housing market much here in the upstate at all. We had a little bit bigger inventory than normal, but houses were moving just as fast. And the price pressures that I would have expected, it didn't seem to have as much pressure on prices. Normally, when mortgage rates go up this dramatically, you will see housing prices move in the other direction. Housing prices didn't fall like we would have anticipated either. And again, for the sake of time, I'll skip the net exports. The other aspect I think that's interesting about one of the drivers of GDP growth over the last 5 quarters has been government spending. And in fact, last quarter, government spending added almost a whole 1 percentage point to GDP growth. And I was wondering what was the underlying driver of this. If I was thinking, well, maybe it was part of the government stimulus package, or maybe it was part of the Inflation Reduction Act, which is really a green energy act. And as far as I could tell, it was none of those. If you look at what was driving government spending, it wasn't the federal government. That's not defense, it's defense. It was the state and local spending that was driving the positive contributions of government spending to GDP growth. And I did a little bit of a dive to see, well, maybe this was because of underlying grants from the federal government to states, but it doesn't seem like that was the case either. What it looks like was that in a fiscal situation, the states and local governments had a bump in tax revenues, and that allowed them to expand the goods and services that they provide. And you can kind of see this in this rise in state and local government employment. So again, one of the things I think is somewhat encouraging is that the government has contributed positively to GDP growth, but it seems like it was a natural outcome of the growth in tax revenues that led to the growth in local and state government, not the case that the federal government, through these different employment and inflation acts, were pushing up the GDP growth. So I think that's a little bit more encouraging. Again, for time, I'll skip that. If you look at the unemployment rate, we'll do this briefly. Again, the one takeaway that I would say from this graph is the state of South Carolina continues in some sense to outperform the national economy, and it has a lower unemployment rate. So again, I think for the upstate in particular, and the state of South Carolina in general, I think the economic forecast will always look similar to what it is for the U.S. overall. But I think things tilt a little bit more in favor of South Carolina, just because this seems to be a place that people continue to want to move to. This seems to be a place that businesses want to relocate to. And they realize there are lots of resources here that are with relatively affordable housing and property values that will continue to allow the state to perform roughly at the same rate as the national economy, most likely a little bit better. If you look at the employment gains, think again, switching from unemployment to what is happening each month in the economy. If you look at the gains in employment month to month from the period of coming out of the pandemic, what we see here, and I'll try to wrap up in about 4 minutes or 5 minutes. What we see here is that each month we've added, again, in June of 2000, in 2020, we added 4.5 million jobs. And you can see we've been on a relatively long period of jobs being added. So we've added almost 27 million jobs since the end of the pandemic. In 2021, we averaged about 605,000 jobs a month. In 2022, we averaged about 399,000 jobs a month. I could have put 400,000. I don't know why I didn't. And in 2023, though, we averaged 232,000. So you can see those numbers are ticking down. And especially if you look at the last few months, you can see they're getting lower and lower. So where we're going to be at next month or the next couple months in terms of adding jobs, that again will give an indication of if the economy is beginning to cool as those employment numbers, if they continue to trend down, then again, that could be a real sign that the economy is slowing down. So first Friday of every month, turn on to either CNBC or Fox Business News at 8:30 to capture what these new numbers are. And again, that'll give us a real indication of what's happening in terms of the employment and where the economy is heading. If you look at gains by sector, you could see that I'll do it this way, put together job gains and job losses. You can see in many industries like professional and business services and education and health, we've gained more jobs than we lost. These are the job losses during the pandemic. And in very few industries, leisure and hospitality is one of the few industries in which we haven't quite caught up to the job losses. But again, across sector, it looks like most of the sectors, take away from here in terms of employment, most sectors have recovered, if not outperformed where they were in terms of employment. If you look at these same sectors by growth in wages, and there are many different ways to cut wages, you can see that there's been positive wage growth. On average, wages have grown from the end of April 2020 up until the last month by about 15%. They've been higher in some sectors like construction and transportation and warehousing, where you've seen, I know, driving up and down 85, you could see the number of trucks going up and down 85 and the amount of warehouses building. It's not a surprise at all that that's putting pressure on wages in that industry. And again, in leisure and hospitality, we know about all the wages they've been, salary increases and bonuses they've been offering the workers. So we see positive wage growth. But the one thing we want to know is how are those wages doing relative to inflation? So this chart here kind of looks at what has happened to overall prices. Overall prices have gone up by 20%. And you can see in some industries, your wages have gone up by more than that. So in some industries, workers in that industry are better off because their wages have driven faster inflation. But that's not true across all industries. And so this is one of the areas where I think you see why people talk about being unhappy with the economy, is that in retail trade and in utilities and in the information sector and some of the other service sectors, that their wages haven't kept up with inflation, and going to the grocery store and buying things at the grocery store are a real burden. I'll skip through those relatively quickly to get to the inflation. The new inflation numbers came out today. They came in a little bit hotter than anticipated. You see a little bit of a tick up here. So again, this will be interesting to see how the Fed reacts to the higher inflation today. But again, the main thing that we saw throughout most of this year, and the thing that we should be encouraged about, was that dramatic fall of inflation that we had over the course of the year without a commensurate drop in employment or a real hard hit to GDP growth. And so now we've moved down to inflation, again, moving down. And I would imagine it would continue to track down as time has moved on. If again, going back to thinking of what consumers expect, and the slide didn't come out like I had hoped it would, so don't look at the right-hand side of the slide yet. I cut this slide here where it was last year. This is consumers' inflation expectations. Last year, we were thinking inflation was going to be high by December, end of December last year. If I fast forward a year later, you and I, as consumers, both now, we believe now that not only is 1 year inflation going to be lower, but also inflation 3 years down the road. So what the Fed has done, I think, not only have they brought down actual inflation, but they've also brought down consumers' expectations about what inflation is going to be. And again, that's really important. If you ever listen to Fed speak, they talk a lot about what inflation expectations are. So not only was it important to bring down inflation, but also from the consumer side and the business side to bring down those inflation expectations. Of course, one of the reasons why inflation has gone down are the improvements of supply chain. So the New York Fed has a measure of the stress put on supply chain. So when this goes up, there's more stress on supply chain. So here you can see when Trump implemented his tariffs back here, that caused some supply chain pressures. And here's where all the supply chain pressures from the pandemic. But over the last year or so, we've seen an easing of a lot of those pressures, and I think that's helped with prices as well. The other thing is I've stressed throughout the lecture over the last year and a half, the other main driver of inflation were the stimulus packages. That and the tilting of consumption towards goods away from services. It was a lot harder to produce goods. When demand jumped for those goods, some of that increase went to quantity, some of it went to prices. So as you look at what happened overall to prices coming out of the pandemic, is that good prices spiked quite a bit. Firms are trying to ramp up production, but they couldn't. Demand was really high. That led to price inflation in goods. But as I had mentioned last year, goods inflation can come down pretty quickly, and that's what we saw. And what I was worried about last year, that when service inflation begins to go up, it will go up, and that has a tendency to be more sticky. And we see that here, that though the Fed has been trying to combat inflation for over a year, it's been able to bring down service inflation, but it hasn't fallen as dramatically as what the Fed would like. And that's why I believe that the Fed will probably not lower interest rates at all during the first quarter until this inflation here on services come back down. So again, I'll try to wrap up here real quickly on the inflation outlook, and then I'll take any questions. The inflation outlook has improved for many reasons. The falling commodity prices, supply chain improvements, the higher interest rates have helped cool demand, the reduction in the money supply, also that the Fed has pulled back in. All of those things have led to a reduction in inflation. Still, core inflation is above that 2% target. So I don't think, as long as it's above the 2% target, I don't think you'll see a cooling of interest rates. So again, it will probably take inflation to get down to below 3.5% to 2.5% before the Fed starts lowering interest rates. And I don't anticipate that happening for the first quarter. But as I mentioned, everything else, when you look at the demand side components, consumption, all the underlying drivers of consumption either are positive or neutral. And on the investment side, most of the indices there that drive investment, whether it's on the fixed investment side, which rely on expectations, or on residential investment side, which relies really on interest rates, those things are either neutral or more favorable now to investment. So again, I have a relatively positive view that we probably won't have anything like a recession until at least through the first 3 quarters. And who knows, again, election season, things could happen. So I know I went about 10 minutes over, so I apologize for that. If there's still time for questions, I'm happy to answer any questions that you may have.
Well, Scott, thank you. Thank you so much. A lot of information to digest there. And I got this is what you see when you walk in my office, positive vibes only. So you gave us some positive vibes today on the economy, and looks like things are trending in a good direction. We are tight on time, and I want to give Justine Allen, our 10 at the top assistant director, an opportunity to give us a quick resource update. And so, Justine, I know we're tight. We got 9 minutes till 4. We want to be sensitive to everybody's time. Hopefully that gives you enough time to give us a quick update. And then we'll try to adjourn by 4 o'clock.
No problem. And if people want to put some questions in the chat for Scott, we can certainly pass those along so he can answer them. And we'll share his slides. So hi, everyone. I have the honor of introducing Kim Holbrooks from the United Way of Greenville today. I do have the video queued up. If you'd like me to go ahead and run it.
Yeah, you can go ahead and show it, Justine. Thank you.
You're welcome.
You have to show share your screen, Justine. It's not showing, Justine.
All right, let's try it again, people. Here we go. Thanks, Erica. I'm just going to do it a different way. We'll see if this will go.
There you go. We're good now.
Thank you.
Wonderful, as evidenced by the various top 10 lists that we show up on almost a daily basis. But I also tell folks that Greenville can be a tale of two cities.
We always show, the shiny parts of our city and of our county, but we know there's also a part of the community where people aren't thriving and people aren't able to achieve their highest potential.
We have over 60,000 people experiencing poverty in Greenville County right now. Many of those children, I can't tell you how many times we chat with people who are $40 away from their electricity being shut off, or need assistance to put food on the table that night until they get paid.
But United Way has long been a leader in convening the community to help identify ways to address these challenges and hit them head on.
Most of my career has been spent in the nonprofit community, and I've been able to see firsthand the difference that the United Way makes, both in funding, but also in leadership and identifying problems and encouraging collaboration to address issues. And all of that is vitally important if we want to continue having the great quality of life that we do here, and a good quality of life for everybody, not just for some.
And that's where United Way comes in. United Way is the organization that represents so many others who are trying to reach down and help people that have fallen behind in any area of our community.
I have a pretty good sense as a sociologist of the economic and demographic transitions that are occurring in the city. Everyone doesn't necessarily have the same amount of time and energy to pour over the census. So I can feel confident when I suggest the United Way to my friends, my family, my colleagues.
United Way's unique model of partnering with other nonprofit organizations in the community while also leading certain initiatives from the front is really compelling. At the end of the day, I know when I support United Way, they are going to invest in the programs and initiatives that will have the biggest impact in this community.
United Way is having a strong positive impact on our community. And by coming together with partners like United Way, we can improve this community, make it stronger and better for more people.
You know that your investment stays right here in Greenville County. It supports people right here. It could be your neighbor, it could be your coworker, it could be somebody that you've never met, you may never meet. But for me, we win when we support each other. It takes you, it takes me, it takes each one of us connecting and contributing to making this a better place. For us to really make a true impact in our community, we need everyone at the table. Every single dollar makes a difference, and the generosity of this incredible community matters.
All right. Well, thank you, Justine, for sharing that. That is our campaign video for this year that our marketing team works every year to put together. So we get excited about that. But as Justine said, I am Kim Holbrooks. I'm the Director of Corporate Engagement here at United Way of Greenville County. And instead of going through and talking about, I think you guys heard from the messaging there. Obviously, poverty is a persistent and big issue here in Greenville County. And that's what we are partnering with agencies to really see how we can impact and help people earn higher earnings to get themselves out of poverty. But one of the things I definitely wanted to mention to you guys, because we have a ton of things coming up in 2024, and I wanted to talk just briefly about a couple of the signature events and kind of give you some results, some of the impacts that we made in Greenville County for 23. As you know, we're wrapping up. We're still in the final stages of finishing up 23 campaign where we're putting together all our dollars and figures and all that. So we've been working on that for the past several weeks, but we have a full calendar coming up in 24. And I wanted to talk briefly about those. I'm happy to share any information with you guys. I know we're short on time, so anything that you would like for me to share with you, I certainly will send to you as well. But one of the things I wanted to say, we do have 4 signature events that we do every year, and wanted to make sure that you guys were aware of that. Obviously, in the first quarter, we have our MLK Day of Service that will take place this Monday. We only have 3 projects set for this Monday. So we have 3 projects, about 83 volunteers. So we'll take care of that. I think a lot of the places and projects that we picked to serve really are holding out for Hog Day. So I'm sure most of you have heard about Hog Day, and we'll talk about that briefly. But we will be completing 3 projects on Monday for MLK. For quarter 2 is our Hands-on Greenville, as people refer to it as Hog Day. This is one of the largest day of service in Greenville County. And just to give you some numbers, just from last year alone, let me put my glasses on so I don't misread a number. Last year, we had 2,332 volunteers on that day coming out. We get projects all around Greenville County. And as you all know, Greenville County is a very large county. So we had 72 projects. We had 108 teams. And typically teams, we have a lot of corporate partners, you know, Michelin, GE, everybody puts together teams to come out and make this a fun-filled event. So we had 71 individuals that signed up. We had over a $300,000 impact to Greenville County just in the work that we performed on that one day. Right after the event, as we finish up our events, we go into Floor Field and do a celebration. So if you haven't participated, please consider this year. Hog Day will be on April 20th. And then in quarter 3, the big event is School Tools. This is where we really focus on bringing our corporate partners together through sponsorships, through volunteerism, putting together backpacks for children that would not have the opportunity to start school with school supplies. And so last year for School Tools, we had planned to give out 2,000 backpacks. Our actual number was 3,067. That's how great the needs were. We try to strategically have 2 different places where people can participate. I'm not sure if you are familiar, but we are currently working we work with all the Greenville County schools, but really focusing on our 6 Title I schools where we have On Track Greenville inside those schools, and really try to put the opportunities for where those folks can get to us. You know, if transportation's an issue, we want to make sure. So we did, one of the events was at Staunton Bridge, where we had the majority of our pickups. And then we also this year had one over to Greer Relief, around the Greer area, and then Simpsonville. So we actually had the 3 locations that people could come we ran out of book packs and backpacks for every event. So that's a good problem to have. So that's the reason we went above and beyond, called on our corporate partners, and was able to service 3,067 of the backpacks. And then in Q4, we actually have 2 events. Last year, we had the Women's United Summit that was here. Sorry, my picture turned purple. That's been happening lately. I promise I'm not doing anything. But the Women's United Summit, we had 442 attendees that came to our Women's Summit. We had our keynote speaker last year, and Todd, just excuse me because Scott, I am a huge Clemson, born and bred into a Clemson family. We had Dawn Staley from the University of South Carolina, which is an amazing lady as well. But Dawn Staley was our keynote speaker that came out. And so we offered 12 different workshops talking about all kinds of things, from financial to, how you become part of a board, So we had a lot of people, but Dawn Staley came, brought out, we had 442 people that participated in the Women's Summit. And then our last project of the year that we just wrapped up is called Project Joy. And Project Joy is where we really focus on middle and high school students, making sure they're going to have Christmas. We have so many things. Our Salvation Army partners do the giving tree and all that. It really focuses on a lot of the elementary kids. We want to make sure we take care of middle and high school that tend to get left out sometimes in those families. So for Project Joy this year, we served 302 families, or 735 children. So we gave them a fantastic Christmas. For that, we had an economic impact of just over $73,000. With that, we had a lot of donations that came in from corporate partners, from community partners, and then we had 67 companies that actually adopted families, that came in and participated. A Greenville County school had asked for 238 families to be served. So out of that, as you see, we had more people reach out and was able to make Christmas just a wonderful event for a lot of folks. But here at United Way, Greenville County, like I said, our mission is, what do we do to break down the barriers that really keep people from higher earning? So we have identified in our focus, if you've heard people talk about how we win, that is our strategy, how we win for Greenville County. And that's really looking at affordable housing, affordable and good quality childcare, transportation, and post-secondary education. So those are some of the focuses that we are committed to being a part of, and working with many, many companies. We awarded 48 grants this year that will be over the 3-year cycle. So 48 partners that we are working with that truly align with our mission, and we appreciate that. We could not do what we do without community partners and corporate partners. So we appreciate you and appreciate the opportunity to get in front of you. But please let us know how we can partner. We're always looking to expand our footprint, get our message out, and become good stewards of Greenville County. So thank you for the opportunity, Justine. Any questions for me?
Nope. I've put your, I went ahead and took the liberty of putting your email in the chat. Hope that's all right. And then, of course, the website for United Way of Greenville. Thanks so much for taking the time today and your speedy delivery.
Thank you. Not a problem.
Back to you, Todd.
All right. Thank you, Justine. Scott, excellent job. Thanks again, Kim. Thank you for sharing the work that the United Way is doing. A wonderful organization. Appreciate what y'all are doing to move the needle in Greenville County. Thank you for joining us today. 2 quick dates, reminders again. Kickoff reception Tuesday, January 30th at the Southern First Building. That is in the chat. Erica also added and reminded us that the next 10 at the Top chat will be February 8th. I think I saw Tom Tyra was on this call, I believe, today. He's the communications director for GSP International Airport. So be sure to register for our next 10 at the Top chat, which again is February 8th. Thank you again for joining us today. I know we ran a few minutes over, but grateful for your participation and your commitment to 10 at the Top. And we'll look forward to seeing everybody, hopefully, January 30th at Southern First Bank. Have a great day.
Thank you, Todd.
Bye-bye.